Hello everyone, this is Waris Karim again with yet another video on cost accounting. This video is particularly for my Accounting 219 managerial accounting students at Alabama A&M University. Hi guys, this is on chapter 4 of Garrison textbook, and the topic that we're going to discuss today is process costing. We had two videos on two chapters of job costing, chapters 2 and 3. The first one was job costing, calculating or computing unit costs, and the second one was on cost flow and external reporting. So now we are on to chapter 4 and on process costing. So I told you while talking about job costing that along with process costing, job costing dominated the accounting world, the managerial accounting world, for decades, because these are the two strongest and dominant traditional costing methods. The only alternative that came out in the last decade or so is, or decade and a half, was activity-based costing. So we still have only job costing, process costing, and activity-based costing. These three costing methods to identify, to calculate costs of units, cost of jobs, cost of production, cost of doing anything, virtually doing anything. Anyway, so what is process costing? Process costing is a costing method or cost accounting method whereby costs are accumulated on a department by department basis instead of on a job by job basis. Remember, it's a costing method where costs are accumulated, gathered for departments, individual departments. So the idea here is that the products go through different processes. It has to be at least two departments to apply process costing. So garments factories or textile mills, these are good examples of application of process costing. Pharmaceuticals as well, and maybe auto industry as well. So anyway, we'll find several other examples as we go in the next few minutes. But the idea is that in case of job costing, we apply cost elements, we accumulate, add all the resources that go into a particular job. And each job is unique, each job is different, and the organization is engaged in several jobs at a time, or at least, doesn't have to be several jobs at a time, but could be one job at a time, but it usually is engaged in many, many jobs at a time. So small, like examples could include cleaning business, where you send out your cleaners to different jobs. They're similar but not identical jobs. And then even lawn mowing. I personally like collision repair companies as a good example of application of job costing, where you try to add the material, labor, and overhead that you need to do a particular collision repair. All right. So in case of process costing, rather, we go like a chocolate factory. We have we add ingredients in one department, and then we do wrapping in another department, we do maybe packaging in another department, we do finishing in another department. As I said, taking textile, for example, we have so many departments like spinning, weaving, dyeing, finishing. So there will be individual departments, and every department will add value to the product, the final product. All right. So the definition again, it's a costing method where costs are accumulated on a department by department basis, and where all units produced by a particular department are identical. So the units are going to be identical. So that means you have a large scale production. You're not going to do just one chocolate at a time. So when you do, say, fashion jewelry, for example, or custom made jewelry, custom made even vehicles like Jaguar once did. So those would be examples of job costing. But when you do batches of products that go through different departments, then that is a good example of process costing. And they actually, we do apply process costing. All right, so some conditions to apply process costing is the homogeneous products. The products are homogeneous, all similar, all the same. The production involves multiple departments, as I said. It has to be at least two departments, and then every department will add value to the product. So this is my first slide. So please take a look and take a read, have a read. All right, thank you. Now, similarities and contrasts between job and process costing. This is based on the textbook. So I find, or Garrison reports, Garrison et al. Report some similarities, and the first one is purpose. They both have the same purpose of accumulating unit costs or product costs. You can see the purpose is to assign material, labor, and manufacturing overhead costs to units. And then both the methods use the same cost accounts, like the same basic manufacturing accounts like raw materials inventory, cost of goods sold, raw materials are work in process inventory, finished goods inventory, manufacturing overhead. So both of them use the same account titles. They use same accounts, same manufacturing accounts. The third similarity is that the flow of costs through the accounts are basically the same. So we still have, like, we purchase material, we issue material, and we add labor, we add overhead, we apply overhead, and then we transfer from manufacturing, from work in process to finished goods, and then from finished goods to cost of goods sold. So the cost flow, the flow of costs between the two costing methods are virtually the same. Well, another the contrasts. I think you can already tell that in case of job costing, we'll have many jobs, but each job is going to be unique, different from each other. In case of process costing, we'll have a single product, like as I said, chocolate factory, but quite a few, large scale. Then costs accumulated by individual jobs. The second point of difference here, costs accumulated by individual departments, like production department, machining department, finishing department. And then we have unit costs are also calculated by the job. Unit costs computed by the job. So we have the total cost of a job, and if the job involves several units, then we divide it by number of units. For example, I receive, since I own a printing press, and I received an order to print, say, a couple of hundred books of a particular author. So that's a job. That's a job. Although within job, it could have several processes in printing a book, like, you know, printing the actual book, then binding, then packing. So you could actually have a situation where you have job costing, and within the job, you could have process costing. You see my point? Say I receive a job to manufacture 2 million doses of a particular vaccine, like remdesivir, the one that's being applied to our president right now, the Gilead Sciences product. So it's a job, true, like 2 million ampoules, 2 million doses of the vaccine, but to manufacture those 2 million or even 200,000, if it involves several departments, then I could have process costing within job costing. Okay. Anyway, so unit costs are calculated by the job first, and then once you have the total cost of the job, you divide it by number of units in the job. And then unit costs are calculated by processes, by departments. So if, say, 2 million units of that vaccine go through 3 different production or manufacturing and other departments, then we enter material and labor and overhead in process number 1, and then we have a particular number of output. We divide it by number of units, number of good units we have, and then it goes to the second process or second department. Then we could add material again, but usually we do not. So we have, or maybe less material but more labor and overhead. Remember, labor and overhead is essentially added at every stage of the production process. Materials, in case of process industry, materials are all added in the first department, like in a garments factory. You know, when they make these t-shirts and trousers and shirts, so dresses. So you apply the fabric and the accessories and buttons and everything at the beginning. So it goes to the cutting department, for example, and then it goes to stitching department, and then it goes to finishing department, ironing department, and sometimes it's even washed before it's being packed for shipping. All right, so these are the similarities and differences. I'd be interested in these in quizzes and tests. Also, I hope it is now clear to you where to apply or what companies are likely to apply process costing, or what circumstances warrant application of process costing versus what circumstances do job costing. All right, now the flow of costs, process costing, flow of costs. Very similar to job costing. I can tell you, you acquire material, so you debit raw materials, like in perpetual inventory system. You debit raw materials when you purchase raw materials and credit cash or accounts payable. I went through this in my last video. And then you issue those materials to the first department, department number 1 or department A or process A. So they're work in process. So remember, as our department receives materials, we load it to work in process. So you just have to modify it. You have to say work in process, department A or department X. And then, so that's debit, and credit would be, what is it coming from? It's coming from materials warehouse. So credit is raw materials inventory, RMI. And then you do the same for process number 2, or if you have several going on at the same time, every time you issue material to a particular process, it's work in process of that particular department. And then credit is going to be raw materials inventory, RMI. If you add indirect materials to that particular process, then you initially load all of it to manufacturing overhead, and then you apply that to the particular process depending on the number of hours or number of allocation base. But if a particular volume of indirect materials, not labor or other intangible, so-called intangible overhead, I like this distinction between tangible overhead versus intangible overhead. You see, indirect material is overhead, but it is tangible. We can count it, we can see it. So if, say, $20,000 worth of indirect material go into a particular even job, then it's okay to debit work in process straight away, then going via overhead. But I think it is customary, and it's maybe safer to add it to manufacturing overhead first and then apply the application rate. But if you know that a certain amount of material, in this case indirect, actually goes into this particular department, then why not just work in process straight away and then use the application rate for the rest of the manufacturing overhead that you could not directly assign to a particular job or particular department. All right, so when labor costs are assigned, we debit work in process again and credit cash or wages or salaries payable. So now labor is added to department number 1. And then when manufacturing overhead is applied, see, we skipped that original accumulation of manufacturing overhead. So, but that's implied that when manufacturing overhead is spent, like when you estimate all those utilities and everything, then it all goes to manufacturing overhead first. And when you even pay for those, it goes to manufacturing overhead. And then based on a predetermined overhead rate, you apply a certain amount to particular jobs, or in this case, processes. So when we apply that overhead, we debit work in process again. See here, when work in process, when manufacturing overhead is applied, debit work in process, specific department, and credit manufacturing overhead. I'm here. And then when goods are transferred from one department to the next, so it looks like with material, labor, and overhead, our products are ready. They have, like, I actually use universities as good examples of process costing. Like we have freshmen, sophomores, juniors, and seniors. So in my freshman class, we could have, say, 2,000, or in the freshman year, we could have 2,000 students. So they're in our department number A or process A. And then of the 2,000, let's say 1,800 to 1,900, they promote themselves, so they get promoted to sophomores. They go to second year. So that's our process number 2. So once you are ready, after finishing the first year, 2 semesters or 3 semesters, you are now ready to be transferred to the next department. So the department receiving you, or the year receiving you, is going to be debited. So work in process department B, or that particular specific department, will be debit, and the one that's letting you go work in process of department A is going to be credit. So you can see here, as these are transferred, work in process department B, and then credit is work in process department A. So see, these are not ready, these are not finished goods yet. So we have interdepartmental readiness or interdepartmental finishing. It's like all the work that's supposed to be done on the products in department A have been done. So now they are ready to go to the next level. So our work in process is letting them go. So will be credited, and their work in process is receiving it. By they, I mean department B. So receiver is going to be debited. Giver is going to be credited. Receiver, remember, is always debit, and the giver is always credit. All right, so that's our first couple of journals of the cost flows under process costing. Okay, so couple more. Then once you're now ready to go, say, to finished goods. So we, in Holmgren's, in the textbook, we had 2 departments, but we could have 3, 4, or 5. So the process continues. Once you're done with work, with all the work, all the value being added in a department, and you are ready to go to the next department, the receiving department's work in process will be debit, and the giving department's work in process will be credit. All right. Now, once all the departmental work or every department is done with the product and the products are ready to be sent to our finished goods warehouse or to the on display to our showcases, then we debit finished goods. So finished goods inventory, FGI, debit, and credit would be work in process of the last processing department, last one of the in the row. It could be, if there are only 2 processes, then it could be department number B or department 2 or process 2. But if there are n number of processes, then it would be department N. All right, so it goes to finished goods, debit finished goods, FGI, finished goods inventory, and credit work in process inventory of the last processing department. And then as all the units are sold, or as the units are sold, then a debit cost of goods sold and credit finished goods inventory, like normal, as I said, perpetual inventory costing system. When goods are sold, we have 2 journal entries, one for sale, another for the cost. So the sale entry is skipped here, but the sale entry is debit accounts receivable or cash and credit sales. So that's implied. That has nothing to do with cost accounting or with what kind of costing method you apply. All right, so this is the end of our cost flow. So what have you seen? What you have seen so far is that the process of accounting for the cost flows, or accounting for the accounting cycle, process costing accounting cycle, you can call it. In my last video, I called it job costing accounting cycle. So now let's call it process costing accounting cycle. Process costing accounting cycle involves all the steps right from the beginning, or accumulation or acquisition of raw materials, purchase of raw materials, then issue them to the first processing department or first, second, third processing departments, and then adding labor, adding overhead, and then once the products are ready, then the process of transferring them to finished goods, and then from finished goods to actually to the customer to effect a sale. All right, so we have just seen the journal entries of the whole process. Simple. Work in process. Remember, work in process debited several times. Only at the time of acquiring materials, you debit raw materials inventory and credit cash or accounts payable. But after that, once these are issued, then work in process department A, work in process department B, work in process department C. And then for material, work in process debit, department A, credit raw materials. For labor, again, work in process debit, credit cash or wages payable, or usually wages payable. Then for overhead, as I said, if there are indirect materials added to it, to the particular process, then it's okay to directly debit work in process instead of going via predetermined overhead rate, because it's clearly visible that it is dedicated to this particular process. All right, but it's also okay to add it to manufacturing overhead and then come back with a predetermined overhead rate. Because remember, if the predetermination leads to over or under applied overhead, then we always have a cure for that. we can deal with under or over applied overhead. Let's say I added $40,000 worth of indirect materials to a particular process, but because I had to go via manufacturing overhead, and then apply at a particular rate, then the actual amount that I ended up applying or ended up charging could be less or more than the actual amount of indirect materials and indirect labor and other things that I have added to the particular process. But it doesn't bother us that much, because if we are short, then you can debit cost of goods sold again. If we are over, if we have added too much or applied too much, then we can take it off cost of goods sold. All right, and back to manufacturing overhead. All right, now this second part of this presentation is going to be a bit will involve some calculations, is a bit arithmetic. I don't still call it mathematical, because mathematics is much smarter things, but it is there are some arithmetic, so some calculations. So please have your pen and paper, and especially your calculator handy. Have your calculators. All right, so the concept that we are going to introduce here is that of equivalent units. We call it equivalent unit. So what is equivalent unit? Equivalent unit is relevant here because in process costing or in actual process industries, there will always be some units that's half done, like half baked, that's half finished or partially finished units at the end of a particular process, until it's at the end, total end. Even in the last, for the last department, last processing department, there will be semi-finished or partially finished units, because the factory never sleeps. So we'll always have accounting year ending on, say, 31st of December, or my week or month ending on the 30th or 31st of a month. But then the factory, there's no guarantee that at 12 o'clock on 31st of March, we'll have no unfinished business, no unfinished units. You know, go and visit a garments factory or a textile mill or any mill, any factory that has manufacturing processes. You'll see there's some finished goods. Finished goods are being transferred, being moved from the factory floor to the warehouse, the finished goods warehouse. But in the factory floor, there are always work going on. So what do you work on? You work on unfinished units. All right. So we'll always have some unfinished units. So for those unfinished units, we try to find out what percentage, what's the degree of completion of those unfinished units. So let's say I'm doing these t-shirts, and at the end of my last process, I have 100, I've completed 100 units, but I also have another 10 units that I'm only half done. So 10 times half is 5, and the 100 that I've already finished, there's 100. So 100 plus 5 is 105 is the equivalent completed units. But in physical terms, I have 110 units, don't I? Because 100 finished, and the other 10 are also units, other 10 are also t-shirts. They will end up in proper finished t-shirts. But right now, they're all 50% done, or if they're 40% done, then 10 times 0.4, 40% of 10 is 4 units. So 40% of 10 units is equivalent to 100% of 4 units. That's the whole idea. Okay, so 10% of, say, 200 units is the same as 20 units 100% complete, or 100% of 20 units. So always multiply the number of units by the degree of completion, okay, and add the ones that are finished, add the finished ones that are completed. So completed units plus incomplete units times their degree of completion. There's the formula. So say this equivalent units of production is units transferred to the next department plus equivalent units in ending inventory of that department. Equivalent units in ending work in process. Yeah, ending inventory of work in process. All right. So say again, the formula for equivalent units is your completed units, or the ones that you have transferred to the next department. So as far as your department is concerned, they're all done, aren't they? They are completed. They're complete. Plus, you have some in work in process. So on some, your work is still going on. So that multiplied by their degree of completion. So I have an example here. I said we transferred 100 units to department B and have another 100 partially completed units at our disposal. So please read it. What did I say? We transferred 100 units to the next department, department B, but also have another 100 partially completed units in our work in process inventory that are 40% complete. So 40% complete. Now this degree of completion could be tricky because you could be 40% complete in terms of materials, but only 10% complete in terms of labor and overhead. All right. Or you could be 100% complete as far as material is concerned because all the materials are already there, but for labor and overhead, you are only 20, 30, 40, up to 90% complete, up to 99% complete, 99 that is. Okay, now you could be curious as to why labor and overhead is always said together. Labor and overhead is said together because material material doesn't follow any hours or anything. Material is issued based on how much material is needed or what is being produced. We add that material, but labor and overhead are intertwined because when labor works, overhead also is being used, overhead is being deployed. Like when I have this video, when I use this room, then see my lights are on, my tea has to be ready, my voice has to be okay, my laptop has to be used, my internet. So I could have, if it is a factory, then I could use the length of the video or length of the total time involved in doing the video, and then I could have a rate like $1 per minute or $2 per minute. Now that $1, $2 would be calculated based on the total cost of running this facility and divided by number of how many minutes we could work. So remember, although there are 30 days and 30 days would have probably thousands of minutes, but if I estimate that in a given month, I'd only be doing 10 videos, and with those 10 videos, I have to recover the cost of using all these appliances, equipment, and the room and the heating and the lighting and air conditioning. Then I'll have to add all the costs and divide it by just 10 videos. And let's say the total length of those 10 videos is supposed to be 300 minutes, half an hour each. So, and if my total cost is $3,000 of running it for a month, then 3,000 divided by 300 minutes. So 300 would make it give you $10. So that means whenever I have a minute of work, 1 minute video, I will be applying $10 of overhead. Okay. All right. So we have labor and overhead. They go together because when I work, then overhead is also being applied. Or although when I don't work, overhead still goes on. The fans would still rotate, the air conditioning would still be on, but we have a smart way. In our predetermined overhead rate, we add all the costs that are incurred throughout the month or throughout the year, whether work goes on or not. Then we divide it by the allocation base. Allocation base is not necessarily 365 times 24. Allocation base would be my estimated number of hours, the actual hours that I'd be working over that month or over that year. So based on that, even if you have your facility going on for 365 days of the year, but if you plan to work only 10 days, 10 of those days, then you could divide your total cost by just 10 and then apply it on a daily basis. Okay, every day we work on something, we apply 1 day's overhead. All right. Okay, so it says that it's 40%. So the second 100, the 100 units that are partially completed, those are 40% complete as far as material goes, as regards materials, and only 30% complete as regards labor and overhead. So now we're going to have two different equivalent units. In both of them, we're going to have the 100 complete ones. So 100 is our base, the ones that are ready, that are fully complete, that are actually complete. And then the incomplete ones, which is also another 100 multiplied by 0.4, 40% for materials. So as far as materials go, our equivalent units is 140. Do you see that? 100 plus 40% of 100. So there's 140 units. And then for labor and overhead, we could have a different equivalent units because they are 100 plus the degree of completion is only 30% as regards labor and overhead. We still have that 100 units that are partially completed, but though on those 100, labor and overhead was applied, or their efforts have been used for only 30%. So there are more, 70% more work to be done on those. So these are the calculations. As I already told you, that our equivalent units is going to be 140 as far as material goes, and 130 as far as labor and overhead go. All right. Now the costing, you can see how we calculate the unit cost using the equivalent units. So this is something you need to take time to complete reading. So you could pause your video and then read it. So what we have here is the total cost that goes in, total all the resources that go in. You can see one column for material, another for conversion. So conversion means labor and overhead. Labor, what do you do with labor and overhead? You convert material into usable products. Like you make chairs, you make furniture. What is a furniture? Piece of furniture. It's actually timber or other material. Then on those material, we have some labor, some people's hands or some machines. In that case, it would be overhead. So man or machine, they have worked on those ingredients, on those materials, timber or plastic or steel or other metal. And then they fabricated, they molded, they converted them into a usable furniture, like a bed, like a sofa, like any furniture. All right. So we have the cost of beginning work in process inventory. I assumed it to be an ongoing process industry. So cost of beginning work in process inventory was $15,000 and $20,000 for material and conversion respectively. So total is $35,000. There's the beginning balance of work in process inventory. And then costs added during the period, costs added during the month or week or the period was $45,000 for material and $100,000 for labor and overhead. So we've added those resources to the units that are being produced in this department, in still just one department, the first department. So that's 145. So 145 plus 35, we need to account for a total of $180,000, of which we have $60,000 of material and $120,000 of conversion costs. And now let's find out what's the unit cost. And you can see it's very easy. So the beginning work in process, that to $15,000 and $30,000, the beginning work in process involved 500 units, 500 whole units, incomplete though, but 500 units. But they were 70% complete as far as materials and 40% complete as far as labor and overhead. So now you know the equivalence of those. So what happened that we first, there are two methods of preparing this statement or computing unit costs. One is called the FIFO method, first in, first out method, and the second one is weighted average method. Garrison and his colleagues, they used the weighted average method in the actual chapter. So we're gonna use weighted average, but if you're interested in, which I would personally recommend, then please take a look at the FIFO method as well. And if I have time, I'll make a short video on that too. FIFO means that you first work on the incomplete unit that you received. It's like, mom's kitchen. When you start in the morning, and if you have any unfinished business, let's say we're having visitors, having guests. So your mom was cooking, or you are cooking. Don't let moms cook all the time. I think we should take leadership in those so-called, thankless household jobs. So I was, say, cooking all day today, and then by the time when I left my kitchen, I left some unfinished work. All right, so next morning, of course, we want to serve fresh. So next morning, my first thing I do is start working on the ones that I left unfinished the night before. So that's called FIFO method. It means you assume that the first ones, the ones that were in beginning, beginning inventory, they are worked on first. So they are finished first. And then we added new units and worked on those, and many of them would have finished. And then the ending inventory that we have would be primarily from the ones that I added during the month or during the period. Because it's impossible, if you follow FIFO, it's impossible for one of the first ones to still be languishing here, hanging around after a month when all their peers, all the other units have already moved on to the next process. You see my point? So FIFO means the first ones are worked on and then they are sent to the next department first. If they're scrapped, if they're that's a different thing. We have normal loss, concepts of abnormal loss, and how do you deal with those? That's different. But there'll always be some system loss. Like if you start on 100 cookies, you won't probably finish with 100 completed and sellable cookies. You probably have one or two that gets broken, or gets burned, or gets overcooked, or undercooked, overbaked, underbaked. Anyway, so what is important here is that we use weighted average. So you do not have to assume that these ones I worked on first, but they said that we blend it all together. They all get mixed up, and then it could well be that some of these are still incomplete at the end of the period. It is possible under the weighted average method, but that doesn't bother our calculations because we use the equivalent units concept. Equivalent units means we ignore the beginning inventory. We only add the ones that we transfer to the next department, or the completed ones, the good ones that have graduated from this process, plus non-graduates, or the ones who are still studying, the ones, the units on which we are still working, times their degree of completion. I think student examples are great because you have, say, we have 1,000 students. Each of them needs, say, 300 points, 300 credits to graduate. And 1,000 have, of the 1,000, say 700 have graduated. The other 300 also about to graduate, but they have only 90% of their credits required. They've got 90% of their required credits under their belts. So 300 times 90% is equivalent to graduating 270 guys, graduating 270 students. Although in physical count, we're going to have 300 students still on campus who are waiting to graduate. All right, so equivalent units, and the weighted average method is easier because you can ignore the beginning ones when calculating the equivalent units. Your equivalent units worked in this department would be the ones you completed plus the ones incomplete times their degree of completion. All right, so we had 500 at the beginning with 70% and 40% degrees of completion. Then we added 4,500 new units, and see what happened to 45. Of the 4,500 units, or 45 plus 500, the initial 500 plus 45, we had a total of 5,000. So see, of the 5,000, 4,000 have graduated. 4,000 have graduated. Now, in FIFO, this 4,000 would invariably include those 500, the beginning 500, unless some of them were scrapped, unless some of them ended up as system losses. Okay, so FIFO means unless you let them go, you could not have started working on other units. You couldn't have initiated work on any new batches. But here, this 4,000 may well or may not have all the 500. I mean, I'd assume it does, but it is theoretically possible that the 500, all those 500 could still be hanging in there, could be languishing on factory floor. All right, so 4,000 is graduated and 1,000 are 30% complete as regards materials, and as far as labor and overhead go, they are only 20% complete. So let's multiply 30%, 0.3 by 1,000, so that's 300. So as far as materials are concerned, our equivalent units are 4,000 plus 300, 1,000 times 0.3. And then as far as conversion is concerned, our equivalent units is going to be 4,000 plus 1000 times 20%, so 4200. One is 4300 and 4200. So here we have those. Easy, isn't it? 4000 plus 300, 4000 plus 200. So there's the number. Now, what's the unit cost? So see how much total material you deployed, how much total material cost you've incurred, divided by total number of completed, total number of equivalent units. Equivalent. We have FTE, the FTE concept at universities, full-time equivalent students. Let's say we have at Alabama A&M, we have 8,000 students. Of the 8,000, let's say 7,000 are full-time, but 1,000 are part-time students, commuter students, or they are post-experience students, or they're working and studying at the same time, so they're part-time students. Now, for grant purposes, for like state allocation purposes, they don't give the same amount of money for a full-time as well as same amount of money for full-time and part-time students. Of course, they make distinctions. We receive more money on behalf of our full-time students than we receive on behalf of our part-time ones. So universities tend to calculate total number of full-time equivalent at the university. So even though we could have 22,000 total numbers, total ID'd students, but our equivalent full-time FTE could be only 19,000. So that depends on how many are full-time and how many are part-time, and the part-time ones and their degrees, how much part-time they are. Like, are they doing only 50% or are they doing only 10%? Because you could just do, come to campus for just one course and that's it. Others could do like 3 or 2. So any less than full-time load. All right. So the unit cost should be total amount of resources. Remember, $60,000 as far as materials was concerned, and as far as conversion, we had 120. The total cost that you have to account for is $180,000. So divide 60,000 by your 4,300 and divide 120 by 4,200. So that's our unit material cost. That's our unit labor and overhead cost. If we add these two, we're going to have total unit cost, even though there are 4,200 and here are 4,300. But it doesn't matter. This is the cost of one equivalent full-time unit. Sorry, one equivalent 100% complete unit. All right. So this is the cost of material. If we want to know that what's the total cost of the units that have graduated to the next department, then you just add these two. $13.95 plus $28.57. All right. So the cost of units transferred. So what's the cost of the 4,000 that we transferred? That would be 4,000 times this plus 4,000 times this, or 4,000 times this plus this, as I say, total unit cost. So that is fine. That's what you see here. 4,000 times this plus this is equal to 4,000 times 42.52. So there will be some rounding errors because of I had to use only 2 decimal points here, but my calculator had, of course, more. So we have rounded it to $170,098. The total cost of completed units, the 4,000, and the total cost of work in process incomplete ones are here, 300. So we have to do it separately because for material there are 300, and for labor and overhead there are only 2. So 300 times this, 13.95, plus 200 times this, 28.57. You can see 400 times this plus 200. Sorry, 300 times this plus 200 times this, which is equal to total of $9,899. So the two together is not exactly $180,000. That's rounding error, but it's close to $180,000. I have $3 short here, but that is just a rounding error. So there is no error of principle. So that is the end of this, or say rather shorter video on process costing. Process costing is considered to be one of the more complicated costing chapters, cost accounting chapters, costing method. But the way these great books narrate it, they present it, they make it much more user-friendly. But if you follow, say, an Indian textbook, the area where I'm from, or the kind of textbooks that we studied, they're all the very important concepts of, or even a British textbook. So these, the two managerial account, the two, I'd say, best accounting accounting, managerial accounting books for undergrads are both American books. One is the one that we are using, Garrison, Noreen, Brewer. The other one is Holmgren, and then later some other co-authors, Holmgren, Sundem, and Dater. It's Charles T. Holmgren, one of the greatest professors of accounting. All right, and so is Garrison. But Holmgren, he won a lot of teaching and research prizes, awards in his life. Anyway, so the way they present is easy. So what we have learned so far is that process costing is different. Process industries are different from job industries. They're totally altogether different businesses. That's why their costing also has to be different, or that has resulted in different costing methods, adoption or application of different costing methods. Job costing is one type, is I'd say slightly easier than process costing. In process costing, you have to constantly keep an eye on what's coming from the previous department and how much resources you're adding. So remember, resources are costs. Resources used is equal to costs. So this managerial accounting is the same as cost accounting or whatever we call it. Important thing is we are accounting for costs, accounting for resources that we spend or spent to achieve. Remember the definition of cost? Resources spent to achieve a particular goal. So here I have received an order of, say, painting a house or replacing a roof. So that's a job. So I have material, I bring in my labor, I bring in my overhead. Now, I don't usually bring in my overhead, but interestingly, see, when people work on your roof, those guys may not have anything to do with headquarters or anything to do with the lawyers or accountants or secretaries or telephone. Yeah, there would be support services, but the whole time labor is working, say 3 or 4 guys working for 5 days and a total of say 50 hours. So overhead is loaded on each of those hours. Because if we don't recover it from our jobs, then who's going to pay for the office? Because office is behind. Those guys are not. I mean, on a previous video, I think I talked a lot about the treacherous nature of overhead. So we'll talk more about it later. In activity-based costing as well, we'll have overhead. Well, and ABC is actually all about overhead, but that's the topic for another day. But what is important for us at this point to know is that overhead is applied on people who have total physical disconnect with where the resources are being spent. That's why it's very important to be fair, to have efficient utilization of those resources, because that is that loads to your cost, and the more costly you are, the less market advantage you're going to have. So if you have a roofer who is prepared to do a job for say $6,000, why would you spend $7,000 on another bid? So your bidding is going to suffer if you have inefficient resource utilization of resources, and those resources mostly account for overheads, the ones who don't directly go on your roof and replace those shingles or architectural ones or tiles, whatever roof you have. All right, so that's roof example is job costing, but the industry where they manufacture those shingles, architectural shingles or tiles that we use in roofing, those are process industries. All right, excellent. Okay, so thank you for your attention, and I hope you have enjoyed listening to my discussions, and I'll see you again on the next video. Our next one is going to be on cost behavior, or CVP, cost volume profit relationships, chapter 5 of Holmgren textbook. All right, thank you. Bye-bye.